Okay, this is the Maryland Real Estate License Exam Prep. We're going to go test number 6, which is economics and appraisals. And we're going to jump right into that with questions and answers. We're just going to get right to it. If the price of an item is increasing, one can usually assume that demand for the item is increasing in relation to supply of the item. When the market for an item has achieved market equilibrium, which of the following statements is true? Supply and demand are equal, and price and value are equal. As an economic product, real estate is distinguished by the uniqueness of every parcel. The city of Stevensville has declared a moratorium on a new construction. If demand is increasing, what will be likely effect on real estate prices in the area? Prices will rise. If Okapi Inc., a company that makes its sports clothing worldwide, moves into Stevensville and hires 100 employees, it is reasonable to expect that the town will increase. The answer, an increase in demand for all types of real estate. What is absorption? Absorption is the number of available units that become occupied over a period of time. When vacancies are declining in a real estate market, it is common for the marketplace to experience rising prices. The price for any product is a function of 4 fundamental determinants of value. These are desire, utility, scarcity, and purchasing power. A town is rapidly growing, but all of the building vacant lots in the most desirable areas have already been occupied. In this case, it is likely that the price of existing homes in that area will increase. If there is a significant undersupply of homes in a market, construction will tend to increase. This is an example of the market tending toward equilibrium. If commercial real estate prices are falling in a marketplace, it is likely that the market is oversupplied. Construction boom in a market is an indication that prices have been increasing. Why is real estate traditionally considered a relatively illiquid economic product? It is often difficult to convert to cash. What does base employment refer to in the contract of real estate demand? The number of persons employed in a base industries in that area. What is vacancy in real estate market economics? The total existing space of a certain type that is unoccupied at a given time. If a moratorium on new construction is an example of local government influencing the real estate market regardless of demand. Of the following potential influences on local real estate market, which one would be considered local rather than regional, national, or global? In and out migrations of major employers. There is a lot of new construction going on in town of Florence. Which of the following would be most likely to be immediate effect on the real estate market? Vacancy rises and prices fall. What kind of real estate users are most concerned with neighborhood quality, access to services, property, amenities, and quality of life in their demand for real estate? Residential. One distinguishing feature of real estate as an economic product is its susceptibility to swings in the local economy. Bill Parsons paid $150,000 for a house to operate as rental property, figuring that he could rent out at a rate of $900 a month and paying a price based on the property's ability to generate a desired future income. Parsons was motivated by the economic principle known as anticipation. Which of the following situations illustrates the principle of contribution? A homeowner adds a third bathroom to a house and thereby increases the appraisal value by $10,000. When a property owner combines two adjacent properties to create a single property with a higher value than the sum of values of the two separate properties, the applicable principle of value is called assemblage. What is the difference between market value and market price, if any? Market value is an estimate. Market price is the price at which the property sold. The first step in the appraisal process, regardless of the appraisal method, is to define the appraisal problem and the purpose of the appraisal. And the final step of an appraisal, the appraiser reconciles the value estimates derived by the various appraisal approaches by weighing the applicability of the approaches and considering the quality of data supporting each approach. Which of the following statements properly describes the central concept of sales comparison approach? Make dollar adjustments to the sale price of a comparable properties to account for competitive differences with the subject. One of the strengths of the sale comparison approach is that it takes into account the competitive value of a specific amenities of a subject property. In making dollar adjustments in the sales comparison approach, the appraiser adds value to a comparable that is inferior to the subject property. The best comparable property for use in the sales comparison approach is the one that requires the fewest and smallest adjustments. A house is being appraised using the sales comparison approach. The house has three bedrooms, 2 bathrooms, and a patio. The appraiser selects a comparable house that has 3 bedrooms, 3 baths, and no patio. The comparable house just sold for $200,000. A bath is valued at $7,000, and a patio is at $2,000. Assuming all else is equal, what is adjusted value of the comparable? $195,000. Which of the following statements properly describes the central methodology of the cost approach to an appraisal? Add the estimated land value and cost improvements and subtract the accrued depreciation of the improvements. One of the strengths of the cost approach is that is very accurate for a property with new improvements that represents the highest and best use. The principal underlying depreciation from physical deterioration is that a property loses the same increment of value each year over the economic life of the property. A property is being appraised by the cost approach. The appraiser estimates that the land is worth $30,000 and the replacement cost of the improvements is $95,000. Total depreciation from all causes is $10,000. What is the indicated value of the property? $115,000. Which of the following statements properly describes how to apply the income capitalization approach to an appraisal? Divide the income a property generates by a rate of return. A strength of the income capitalization approach is that it uses a method that is always used by investors to determine how much they should pay for an investment property. A property is being appraised using the income capitalization approach. Annually, it has estimated gross income of $60,000, vacancy and credit losses of $3,000, and operating expenses of $20,000. Using a capitalization rate of 10%, what is the indicated value to the nearest thousand? $370,000. An apartment building that sold for $450,000 had monthly gross rents of $3,000. What is the monthly gross rent multiplier? 150. 150. A rental house has monthly gross income of $1,200. A suitable gross income multiplier derived from market data is 14.1. What estimated sales price to the nearest 1,000 is indicated? $203,000. A certified appraiser is one who has received certification by the state in which the appraiser operates. The act that required federally related appraisals to be conducted by a certified appraiser is known as the Financial Institutions Reform, Recovery, and Enforcement Act, FIRREA, FIRREA. Financial Institutions Reform, Recovery, and Enforcement, the act that required federally related appraisals to be conducted by a certified appraiser. As a component of real estate value, the principal and substitution states that if two similar properties are for sale, a buyer will purchase the cheaper of the two. The highest and best use of a property is that use which is physically and financially feasible, legal, and the most productive. Lynn just bought a house. She paid $187,500 for it, even though it had been listed for $195,000. An adjoining property owner, Kim, had tried to buy the property for $185,000, but had been refused. He now offers Lynn $190,000 for the house. Lynn is interested, so she hires an appraiser. The appraiser returns an estimated value of $200,000. Which of these numbers can be called the market value? Answer: $200,000. A notable weakness of the sales comparison approach to value is that there may be no recent sales price data in the market. In the market data approach, an appraiser selects comparable properties, adjusts the comparables, and estimates the value. In the sales comparison approach, an adjustment is warranted if the seller offers below market seller financing. To compete the sales comparison approach, the appraiser weighs the comparables. One weakness of the cost approach for appraising market value is that market value is not always the same as what the property costs. The cost of constructing a functional equivalent of a subject property is known as replacement cost. An office building lacks fiber optic cabling to accommodate the latest communications equipment. This is an example of functional obsolescence. A home is located in a neighborhood where homeowners on the block have failed to maintain their property. This is an example of incurable economic obsolescence. In appraisal, loss of value in a property from any cause is referred to as depreciation. In the cost approach, after estimating the value of the land and the cost of the improvements, the appraiser estimates depreciation, subtracts depreciation from cost, and adds back the land value. Which regulatory entity code establishes standards for an appraiser's methods, reporting methods, and disclosures? Uniform Standards of Professional Appraiser Practice, USPAP, USPAP, Uniform Standard of Professional Appraisal Practice. Test 7 of the Maryland State is finance. What is a lien theory state? A state in which a mortgage has equitable title to a secured property. What is the function of a note in a mortgage or trust deed financing arrangement? It is the evidence of the borrower's debt to a lender. When homebuyer Henry pledges his newly purchased home as collateral for a mortgage loan, the evidence of the pledge is the trust deed or mortgage. The borrower in a mortgage loan transaction is known as the mortgagor. If a borrower obtains an interest-only loan of $200,000 at an annual interest of 6%, what is the monthly interest payment? $1,000. That should be $1,200 in my opinion. Let me pause that. Multiply the rate times the loan amount and divide by 12 to calculate monthly interest. Thus, $200,000 times 6% divided by 12 equals $1,000. If a borrower's monthly interest payment on an interest-only loan at the annual interest rate of 6% is $500, how much was the loan amount? $100,000. The equation for the loan amount is annual interest divided by the interest rate equals loan amount. Thus, $500 times 12 divided by 0.6 equals $100,000. A borrower of a $50,000 interest-only loan makes an annual interest payment of $3,750. What interest rate is the borrower paying? Answer: 7.5%. The equation for interest rate is annual payment divided by loan amount equals interest rate. Thus, $3,750 divided by 50,000 equals 7.5. Maria borrows $100,000 and pays 2 points for the loan. How much does she pay in points? $2,000. Which of the following is true of an amortizing loan? Part of each periodic payment is applied to repayment of the loan balance in advance, and part is applied to payment of interest in arrears. For a loan that is not backed by the Federal Housing Administration or Veterans Administration, and for which the borrower is making a down payment for less than 20%, the lender is likely to require the borrower to obtain PMI, private mortgage insurance. What is a loan-to-value ratio? The fraction of the appraised value of the property offered as collateral which the lender is willing to lend. That's a bad question for that. 7.11. Let me make sure that's right. That's a very stupid answer. That is just stupid. And that's the answer. The fraction of the appraised value of the property offered as collateral, which the lender is willing to lend. It's just a shitty answer for that. The difference between what a borrower has to pay to purchase a property and the amount a lender will lend on the property is the buyer's down payment. That doesn't make any sense either. That's right. These are right. I'm double checking them. Another stupid question. The Equal Credit Opportunity Act prohibits a lender from refusing a loan because the borrower does not match the lender's target market. A loan applicant has an annual gross income of $72,000. How much would a lender allow the applicant to pay for a monthly housing expense to qualify for a loan if the lender uses a income ratio of 28%? So 3 times 7 is 20 some hundred. So 1680. 1680 is the answer. AMC Bank discovers in considering buyer Bob's application for a mortgage loan that Bob has borrowed the down payment from an uncle and has to repay that loan. Bob should expect that AMC Bank will adjust the applicant's debt ratio calculation and lower the loan amount. The Federal Reserve's Regulation Z applies to which loans? Reg Z applies to which loans? All loans secured by a residence. If a particular loan falls under Regulation Z, right of rescission provisions The borrower has limited right to cancel the transaction within a certain period. Under the Equal Credit Opportunity Act, a lender or real estate agent who assists a seller in qualifying a potential buyer may not ask the borrower about his or her religious or national origin. A conventional mortgage loan is one that is not FHA insured or VA guaranteed. Conventional, not FHA insured or VA guaranteed. The assumability of an FHA insured loan is limited by when the loan was originated. A VA certificate of eligibility determines how much of the loan the VA will guarantee. A borrower obtains a 30-year fully amortizing mortgage loan of $50,000 at 8%. What is the principal balance at the end of the loan term? 0. Which of the following describes a purchase money mortgage financing arrangement? The buyer gives the seller a mortgage and note as part of the purchase price of the property. A homeowner borrows money from a lender and gives the lender a mortgage on the property as collateral for loan. The homeowner retains title to the property. This is an example of hypothecation. Which of the following correctly describes the flow of money and documents in a mortgage loan transaction? The borrower gives the lender a note and a mortgage in exchange for loan funds. In a deed of trust transaction, which of the following occurs? The trustor conveys title to a trustee in exchange for loan funds from the beneficiary. A lender lends money to a homeowner and takes legal title to the property as collateral during the payoff period. They are in a title theory state. Most states are title theory states. A lender who charges a rate of interest in excess of legal limit is guilty of usury. A lender is charging 2 points on a $60,000 loan. The borrower must therefore pay the lender an advance amount of $1,200. The difference between a balloon loan and an amortized loan is an amortized loan is paid off over the loan period. A distinctive feature of promissory note is that it is negotiable. It is a negotiable instrument. When the terms of the mortgage loan are satisfied, the mortgagee may be required to execute a release of a mortgage document. In addition to income, credit, and employment data, a mortgage lender requires additional documentation, usually including an appraisal report. The three overriding considerations of a lender's mortgage loan decisions are the ability to repay, the value of the collateral, and the profitability of the loan. The reason lenders consider the loan-to-value ratio important in underwriting is that they want to ensure there is more than enough collateral to cover the loan amount. The Equal Credit Opportunity Act, ECOA, requires lenders to consider the income of a spouse in evaluating a family's creditworthiness. Lenders use an income ratio in qualifying to ensure a borrower has earning power to make the loan payments. The debt ratio formula used to qualify borrowers is debt payments divided by gross income. At the closing of a mortgage loan, the parties complete all loan origination documents and the loan is funded. Which law or regulation requires mortgage lenders to disclose financing costs and annual percentage rate to a borrower before funding a loan? The Truth in Lending Laws and Regulation Z. Which laws or regulations prevent mortgage lenders from discriminating in extending credit to potential borrowers? The Equal Credit Opportunity Act. Which law or regulation requires the mortgage lenders to provide an estimate of closing costs to a borrower and forbid them to pay kickbacks for referrals? The Real Estate Settlement and Procedures Act, RESPA. Which of the following are methods used by Federal Reserve systems to regulate the money supply? Buying securities, changing the discount rate, and controlling bank reserves. How does the secondary mortgage market aid borrowers seeking a mortgage loan? It cycles funds back to primary lenders so they can make more loans. The major organizations operating in the secondary mortgage market are Fannie Mae, Freddie Mac, and Ginnie Mae. Secondary mortgage market. What is the role of Fannie Mae in the second mortgage market? It purchases FA-backed and VA-backed loans. What is the role of the Federal Housing Authority in the mortgage lending market? FHA. It insures loans made by approved lenders. What is the role of Veterans Administration, the VA, in the mortgage lending market? It guarantees loans It guarantees loans made by approved lenders. In a graduated payment mortgage loan, the loan payments gradually increase. In a buy-down, the borrower pays additional interest at the onset in order to obtain a lower interest rate. And we'll stop now. The next test will be Test 8, Investments, Taxation, Professional Practices.